In the 1980s, when everyone else was panicking, a small group of traders were quietly stacking millions. These traders weren't born different. They weren't lucky. They just learned to see the market different from how 95% of traders see the market. They learned to see the market like a chess master sees the chessboard. And Jack Schwager hunted these traders down. He asked them the questions that no one dared to ask. And the answers to those questions became one of the most powerful trading books ever written, Market Wizards. In this video, we're not just going to review the book. We're going to pull out the blood, the sweat, the psychology, and the exact mindset that separates a market wizard from everyone else who blows up their account. Whether you trade Forex, stocks, crypto, or options, what you're about to hear could change how you see the market forever. The Legend of the Wizards. Imagine this. You're in New York City, 1989. The market floor is chaos. Screens flashing red, traders screaming, phones slamming down so hard the plastic cracks. And yet, in a quiet corner office far from the noise, a man named Tudor Jones leans back in his chair, calm, focused, like a general watching the battlefield from a hilltop. He's not guessing. He's not gambling. He's hunting. Across the country, in another quiet room, Seykota sits in front of his computer. This man turned $5,000 into millions long before algo trading was even a word. And somewhere else, a trader named Marty Schwartz, once a Marine, now a market sniper. These men and others like them were the original market wizards. And Jack Schwager, a market analyst, decided to track them down, interview them, and find out what made them extraordinary. The result? A book that every serious trader has either read or wishes they had read sooner. But here's the truth. Market Wizards is not a book about trading systems. It's a book about trader psychology. It's about why 95% of traders fail, and why 5% seem almost superhuman. And the beauty of this book is that the principles are timeless. So in this video, we are going to strip away the hype and go deep into the hidden traits all market wizards share, the psychological battles that make or break traders, the biggest mistakes that cost fortunes, and how to avoid them, and finally, actionable takeaways from Schwager's interviews that you can start using today. This is not theory. These lessons are from men who made their millions in the trenches. The Napoleon paradox. Calm in chaos. Picture the greatest war ever fought on this earth. The Battle of Austerlitz, also known as the Battle of the Three Emperors. Cannon fire shreds the earth. Muskets blast smoke into the air. Men are shouting, horses screaming, the ground shaking under every step. In the middle of all this chaos, one man stands still. His breathing is slow. His face is calm. That man is Napoleon Bonaparte. He doesn't see the noise. He sees patterns. He sees the enemy's flanks opening, the timing of a charge, the moment to strike. Now replace cannons with candlesticks, horses with hedge funds, and muskets with market orders. This is exactly what separates the traders and market wizards from the 95% of people who blow up their accounts. Calm is their edge. Jack Schwager's interviews revealed something unexpected. The most successful traders are not the smartest people in the room. They're the calmest. This is the Napoleon paradox. In moments when everyone else is losing their head, the rare individual who stays calm has an enormous advantage. Take Tudor Jones. This is a man who made hundreds of millions by shorting the 1987 crash. While the world panicked, he wasn't praying for the market to come back up. He was preparing for it to collapse. And when it did, he was ready. Jones says, don't be a hero. Don't have an ego. Always question yourself and your ability. That humility allowed him to think clearly under pressure. Then there's Marty "Buzzy" Schwartz. Before he became a legendary trader, he was a Marine. In combat, he learned how to function when the world turns upside down. When he stepped into trading, that discipline became his secret weapon. In the book, he says, When you have a losing day, get out. Take a break, reset. It's not about fighting the market. It's about surviving to fight tomorrow. Ed Seykota takes it even further. He automated his system so that emotions wouldn't interfere at all. He once said, "Win or lose, everybody gets what they want out of the market. Some people seem to like to lose, so they win by losing." This strange-sounding quote reveals a deep truth. If you're emotionally addicted to the drama of trading, you'll subconsciously sabotage yourself. Here's why calmness is so powerful. When the market suddenly crashes or spikes, your amygdala, the primitive part of your brain, takes over. It screams, "Do something. Fix it." That's why beginners panic sell at the bottom and panic buy at the top. But the calm trader, their prefrontal cortex stays online. They think strategically while everyone else reacts emotionally. It's the same reason soldiers are drilled to act under pressure. In chaos, your habits take over. If your habits are panic, you panic. If your habits are discipline, you execute. How to build calmness. Building calmness while trading isn't just about being zen. The wizards trained for calmness the way athletes train for strength. Here's how. They plan before the battle. Napoleon never showed up to a battlefield without a plan. Neither did these traders. Before the market opens, they already know where they'll enter, where they'll exit, and how much they will risk. That way, when the chaos comes, they're not improvising, they're executing. They accept losses as ammunition spent. Think of trading like a general spends ammunition. Losses are just bullets fired. They don't cry over every shot. They just make sure they don't run out of ammo before the battle ends. 3. They detach from the outcome of their trades. Paul Tudor Jones doesn't measure himself by one trade. Marty Schwartz doesn't either. They think in series of battles, not one skirmish. They create psychological distance. Some wizards literally step away from the screen after a losing streak. Why? Because they know the next decision they make could come from anger, not logic. The market is a battlefield. On a battlefield, the general who panics gets crushed. The general who acts too slowly also gets crushed. The general that wins is decisive, but calm. In the market, it's the same. When you trade in fear or greed, you're essentially a soldier shooting wildly. The wizards? They're snipers. One shot, one kill. Then they move on. Remember the March 2020 COVID crash? Markets plunged 30% in a few weeks. Most retail traders panicked. Some sold at the very bottom. But the calm, disciplined traders saw opportunity. This very same principle from market wizards applied. Stay calm, stick to your plan, trade the setup, not the emotions. So tonight, ask yourself, if an event happens tomorrow and the market opened to a 20% drop, what would I do? If your answer is, I don't know, you're not ready for battle. A wizard knows before the cannons fire. This is why the first great truth of market wizards is simple but brutal. If you can't be prepared and stay calm, the market will take your money and hand it to someone who can. The second lesson from market wizards is that trading isn't about profit, it's about risk. And to understand this lesson, we need to go back not to Napoleon, but to the engineers of ancient Rome, who were willing to stand under the bridges they built. Risk first, profit second. In ancient Rome, there was a brutal law for engineers. When you built a bridge and it was ready for the public to cross, you were required to stand under it when the first cart passed over. Why? Because the Romans understood something that most traders never learn. If you don't trust your structure with your own life, you have no business building it. Now, what does that have to do with trading? Everything. Because before the market wizards thought about profits, they thought about risk. They built their systems like bridges, strong foundations, tested against pressure, ready to withstand storms. And they were willing to stand under their own decisions. Here's what 95% of traders who never succeed in trading do when they start trading. They think about how much money they can make. They ignore how much they can lose. And when the storm hits, their account collapses like a poorly built bridge. The market wizards flipped this upside down. Jack Schwager discovered that these top traders are obsessed with risk management to the point of paranoia. Tudor Jones is famous for one quote that has become legendary. "Don't focus on making money. Focus on protecting what you have." He has a rule. If he loses 1 to 2% of his capital in a day, he immediately stops trading. He doesn't try to make it back. He knows that revenge trading leads to ruin. This is why when the 1987 crash came, he not only survived, he thrived. He had already prepared for the worst-case scenario. Bruce Kovner, one of the greatest macro traders, said something that should be engraved on every trader's screen. "Whenever I enter a position, I always know where I'm getting out. Always." Before he even places the trade, he already knows his exit. Why? Because he doesn't trust the market. He trusts his plan. Kovner compared trading without a stop-loss to driving a car without brakes. You might be fine on a straight road, but the moment there's a curve, you're dead. Another risk weapon that Schwager's wizards use is position sizing. They don't bet their whole account on one idea. Even if the setup looks perfect, they only risk a small, controlled amount. Think about the Roman bridge again. They didn't build a bridge that could just hold one person on a sunny day. They built it to hold heavy carts, in the rain, during war. In trading, position sizing is your reinforcement. Why most traders ignore risk? The moment someone sees a chart that went from $1 to $100, the mind immediately asks, "What if that had been me?" This fantasy hijacks the brain. Risk becomes invisible because they're hypnotized by the dream of fast money. And there are some traders who experience beginner's luck. A few good trades in a row make them think, "This is easy. I've cracked the code." Those early wins create a dangerous illusion of skill, and they start betting bigger and bigger just before reality slaps them. Many traders think in terms of being right or wrong instead of probability and risk reward. If a setup looks good, they assume it has to work. They never stop to ask, what if it doesn't? For many traders, trading is a way to prove something to their family, to their friends, to themselves. When ego is in control, protecting capital feels like weakness. They don't want to play defense. They want to be a hero. And for some traders, risk is invisible to them because they haven't been hit hard yet. The market wizards all say the same thing. You don't truly respect risk until you've had your account blown up. Some traders haven't felt that pain yet. So like a soldier who has never been to war, they underestimate how fast things can go wrong. In today's world, traders are bombarded by screenshots of profits on Twitter, Instagram, YouTube. The internet rarely shows risk management. It only shows Lambos, yachts, and 300% gains. This creates a dangerous mindset. Why should I play small when everyone else is making millions overnight? Deep down, many traders don't see trading as a business. They see it as a lottery. And when you think you're buying lottery tickets, why bother with risk management? After all, it's either all or nothing. Many traders believe that a perfect strategy or a holy grail indicator will save them. They think, if my system is good enough, I won't need to worry about risk. This is like building a bridge and assuming there will never be a storm. Most traders ignore risk because the feeling of risk is addictive. Talking about stop losses, position sizing, and risk control doesn't give an adrenaline rush. Most traders crave action. They crave the rush of winning big. When you take a massive position, your heart races, your adrenaline spikes, and for some people, that feeling is the real reason they trade. Combine all these reasons, and what do you get? Traders who don't just underestimate risk, they deliberately walk past it, eyes closed, smiling. And this is exactly why 95% of traders lose. 95% of traders build paper bridges. In the market? The market has a way of teaching them these lessons anyway. As the saying goes, if you don't respect risk voluntarily, the market will teach you to respect it by force. So, to not be a part of the 95% with paper bridges, you need to learn how the market wizards build their bridges. They never risk more than a small percentage on any single trade. Most wizards keep risk below 1% to 2% of their capital per trade. This way, even 10 losing trades in a row won't destroy them. They know their exit before entry. Remember Bruce Kovner's rule. I always place a stop before I make the trade. This turns random chaos into controlled risk. They diversify their battlefronts. Many market wizards spread risk across strategies and instruments. Why? Because no one knows the future. They accept risk emotionally before they place their trade. This one is key. Seykota said, if you can't sleep at night because of your positions, you're trading too big. If your trade is so large that you're emotionally tied to it, you're already compromised. The market wizards understand that the market owes them nothing. It doesn't care about your dreams, your rent, or your feelings. It's a battlefield. And no matter how skilled or smart you think you are, your only true protection is your risk management. Long-Term Capital Management, LTCM, was a hedge fund run by Nobel Prize-winning economists. These men were geniuses. But they forgot one thing. Genius doesn't replace risk control. They used massive leverage, ignored risk, and when the market turned against them, they blew up spectacularly. The lesson? It doesn't matter how smart you are. Without risk control, you will lose everything. In 2022, when Luna, Celsius, and FTX collapsed, most people who got wiped out weren't wrong about crypto in the long term. They just risked too much in the short term. They'd put all their eggs in one basket. The market wizards would never do that. They understand that the goal is to survive first, then thrive second. Risk first, profit second. The first goal is to stay in the game long enough to see the big opportunities. So tonight, write this down. If my next 10 trades are all losers, will I still be in the game? If the answer is no, you're risking too much. The Roman engineers who built their bridges knew one thing. Failure costs lives. For traders, failure costs your capital. The market wizards build their trading careers like Roman bridges so strong that even if the world collapses around them, their foundation holds. In the next section, we'll move to something just as important as risk, the edge. Because once you know how to survive the storm, you need a weapon that can actually win battles. And to explain that, we're going to step into the world of the samurai. The edge, knowing your weapon. In feudal Japan, a samurai didn't carry 10 weapons. He didn't rely on flashy armor, magical luck, or cheap tricks. He had one blade, and he mastered that blade until it became an extension of his body. He knew its weight, its reach, its strengths, its limitations. He practiced the same movements 1,000 times. Not to be fancy, but to be deadly. That's what having an edge in trading is like. It's not about having 50 indicators. It's not about watching 20 currency pairs or running 5 different systems at once. It's about mastering one approach so deeply that you can use it with deadly precision, just like a samurai with his sword. What is an edge? In the world of trading, an edge is a repeatable, tested approach that gives you a statistical advantage over time. It doesn't mean you win every trade. It means that over 100 trades, your system keeps you consistently profitable. But here's the thing. Most traders don't even know whether they have an edge because they've never tested anything long enough to find out. But each market wizard Schwager interviewed had a clearly defined edge. They didn't trade randomly. They didn't guess. They had a specific method, and they stuck to it with military discipline. Ed Seykota is the trend follower. Ed's edge was based on trend-following systems. He didn't try to predict the market. He reacted to what price was actually doing. And when the trend was over, he was out. Simple Clear, effective. His results? He turned $5,000 into over $15 million for his clients. That's not magic. That's mastery of one weapon. Marty Schwartz is the technical gladiator. He used technical indicators like moving averages and momentum. His edge was timing. He was looking for short-term swings in the market. He didn't care about fundamentals. He cared about price behavior. He said, "I used fundamentals for the first few years and got slaughtered. Then I switched to technicals and the results changed overnight." Again, one weapon, mastered. Bruce Kovner is the macro strategist. Kovner had a broader, macro-based edge. He used fundamental analysis and technical confirmation to enter trades. But again, his edge wasn't everything under the sun. It was specific. He focused on a few markets where he had deep insight and executed with precision. Why most traders have no edge? The concept of getting an edge in the market might sound foreign to you. You might think an edge is something reserved for master traders who are smarter than you, have technical knowledge than you, have more resources than you, but you can't be more wrong. None of these reasons is why you are yet to get an edge. The reasons why most traders don't have an edge are more simpler and less sophisticated. And they are: 1. Most traders switch systems constantly. They try something for a week. It doesn't work. They jump to the next thing. No edge can survive this chaos. It's like a samurai switching swords in the middle of battle. 2. Most traders don't track data. If you don't track your trades, you're flying blind. You can't improve what you don't measure. Every market wizard keeps meticulous records. They treat their system like a lab experiment. They study it, refine it, and sharpen it. 3. They want certainty, not probability. Your edge is not a guarantee. It's not 100% win rate. But most traders want perfection. So when they lose a few trades in a row, they assume the system is broken. Wizards know better. If the system works over time, short-term losses don't shake them. 4. They copy without understanding. Just because you buy someone's strategy or indicator doesn't mean it fits your personality. Marty Schwartz once said, "The key to success is emotional discipline." If you don't understand your system deeply, you'll abandon it under pressure. That's like picking up a samurai sword without training and expecting to win a duel. You must master your blade. The market wizards all show one thing. You don't need a complex system. You need a deeply understood one. One setup, one strategy, one risk plan, over and over again. Boring? Maybe. But in trading, boring is good. Boring is profitable. Steps to find your own edge. If you don't have an edge yet, here's what you do. Step 1. Pick a style that fits you. Are you a swing trader? Scalper? Position trader? Trend follower? Pick a style that matches your personality and schedule. Step 2. Backtest it. Go back through 100 charts, find the setup. Track win rate, risk to reward, drawdown, time in trade. This is the homework most traders never do. But this is where the edge is born. Step 3. Trade small and track everything. Once your system is ready, trade it live with small size. Track every detail. Did you follow your rules? Did you exit too early? Did you over-leverage? Refine like a samurai sharpens his blade. Step 4. Go deep, not wide. Don't add 5 new indicators. Don't chase new systems. Go deeper into the one you have. There's gold there. But you have to dig. Edge isn't exciting, it's deadly. A samurai doesn't need to be flashy. He doesn't need 5 swords. He needs one technique that works every time. That's what an edge is. And every market wizard had one. They didn't try to conquer the market with complexity. They won by mastering simplicity. The average trader is a man with 10 dull blades and no plan. The market wizard is a samurai with one sword, razor sharp. In the next section, we'll go deeper into what separates those who survive from those who thrive. Because once you've built your fortress and chosen your weapon, you must be able to adapt or die. And to understand that, we turn to the man who understood survival better than anyone else, Charles Darwin. Adaptability. Darwin in the markets. It is not the strongest of the species that survives, nor the most intelligent, but the one most responsive to change. Charles Darwin. Darwin didn't study the markets, he studied life. And yet, his conclusion perfectly describes the secret to long-term trading success. It's not the traders who are strongest, smartest, or fastest that survives the markets in the long term. It's those who can adapt to the changing environment. The markets are evolving creatures. The markets are not fixed. They breathe. They evolve. They mutate. What worked in the bull market won't work in a sideways chop. What worked in 2020 might not work in 2025. In 2020, everything flew. Momentum traders printed money in a zero-rate world. Then 2022 hit, and interest rates exploded, volatility spiked, and macro turned upside down. Those who adapted, who redefined their edge, survived. Those who didn't, gone. Notice I said, redefined their edge. Because you might be thinking, wait, didn't you just tell me in the last section to master one edge and stick to it? Yes, mastery is non-negotiable. But here's the nuance. Your edge is the blade. Adaptability is knowing which battles to fight and when to sheath the sword. The market wizards didn't abandon their methods. They redefined them. They understood which conditions made their edge stronger and which conditions made it vulnerable. So it's not about constantly switching strategies. It's about staying loyal to your core method while adjusting position sizing, expectations, and setups based on the environment. If you're the kind of trader who clings to one setup or one theory as if it were gospel, you're already becoming extinct. Here's a brutal truth. The market evolves faster than most traders' egos can handle. That's why the turnover rate is so high. That's why most never last more than 2 years. Because while the market is shifting like a living organism, the average trader is stuck in last month's playbook. But the market wizards adapt like survivalists. One of the clearest themes Jack Schwager uncovered is this. Market wizards are students of change. They are not married to a system. They are married to the truth of what's happening now. Bruce Kovner, the macro shifter, didn't fall in love with his predictions. He said, I don't pick a side. I look for imbalance. When that shifts, I shift. He adapted to interest rate cycles, currency movements, and geopolitical shocks. He didn't resist change. He flowed with it. Michael Marcus told Schwager that one of the biggest lessons he learned early on was this. Don't marry your opinion. If the market says you're wrong, you're wrong. No debate, no justification. Just get out and reassess. Paul Tudor Jones once shorted the market aggressively, then reversed his position the next day. Why? Because he read the shift. He said, losers average losers, but winners cut fast and change direction. He's not attached to being right. He's attached to winning. The psychology of rigidity. Now, let's talk about the dark side. Why most traders struggle to adapt? Because adaptation sounds easy, right? Just change when the market changes. Simple, but it's not simple. Because there are 3 psychological forces working against you. 1. Cognitive bias. Confirmation. We look for evidence that we're right, even when we're wrong. You're long on Euro USD, and the trade starts bleeding. Instead of cutting, you search Twitter or news sites for reasons to stay in. Your brain protects your ego, not your capital. 2. Emotional attachment. After spending hours planning a trade, you feel emotionally invested. It becomes your idea, your identity, and changing your position feels like admitting failure. But market wizards know your loyalty belongs to your account, not your opinions. 3. Fear of uncertainty. Change creates uncertainty. and the human brain craves predictability. Adapting to new market conditions means stepping into the unknown. It means letting go of past patterns. And for many traders, that fear is too strong. So they stay where it's safe until their system stops working and their capital disappears. How to adapt like a wizard. The best traders evolve constantly, but not randomly. And here's how they do it. 1. Journal your environment. A true wizard doesn't just journal his trades. He journals the environment. Trending or ranging? Volatile or calm? Macro shifts? Fed news? War? Track these patterns. They show you what market DNA you're trading in. 2. Have adaptive playbooks. Professional traders build playbooks, like a quarterback preparing for different defensive schemes. They don't have just one strategy. They have multiple plays, depending on trend conditions, volatility, and asset class behavior. Your strategy in a bull run shouldn't be the same as in consolidation. 3. Detach from ego. Every month, review your trades. Ask yourself, where did I resist change? Where was I stubborn? Be ruthless. Be honest. Be a scientist, not a cheerleader. 4. Backtest adjustments, not just strategies. Most traders only backtest their strategy, but wizards test how that strategy performs across different environments. They don't assume the market will adapt to them. They adapt to it. Adaptability isn't just about having multiple strategies. It's a mindset. A flexible, humble, observant mindset. It says, I could be wrong. Let me see what the market is telling me now. Let me retest this under new conditions. The moment you say, this worked last year, it should work now, you're already falling behind. Adaptability is more valuable than prediction. React faster than others, and you'll win even without being first. The market wizards know what Darwin taught. Survival doesn't go to the smartest. It goes to the one who adjusts the fastest. In trading, this means shedding your old skin when the conditions demand it. It means moving from trend to chop, bull to bear, optimism to realism, without hesitation. In the next section, we'll move from evolution to something even more personal, the battle between confidence and ego. Because once you've learned to adapt, you must learn how to trust yourself without lying to yourself. Confidence versus ego. Julius Caesar was one of the most dominant military commanders in history. But what made him dangerous wasn't brute strength, it was his mental control. He could walk into a senate full of enemies and speak with such poise that they laid down their weapons. He could stand on the battlefield, outnumbered, and still command like a man who had already won. But here's what made Caesar truly powerful. He had confidence, not ego. He didn't assume he was invincible. He planned as if failure was possible. It acted like success was inevitable. Now compare that to some of his generals who are arrogant, hot-headed, and overconfident after a few victories. They rushed into battles they didn't understand, and they were crushed for it. Traders face the same battle. One of the most powerful psychological patterns Schwager uncovered in Market Wizards was this. The greatest traders are confident, but they are never arrogant. They believe in their process, but they never think they're invincible. There's a razor-thin line between self-belief and self-destruction, and every trader must learn to walk it. Confidence builds account growth. Ego destroys it. Confidence says, this setup fits my system. I've seen it work. I'm prepared to lose small and win big. Ego says, this setup can't fail. I know the market's going up. I'm increasing my size. Confidence respects risk. Ego ignores it. Confidence is focused. Ego wants to prove something. Confidence makes you consistent. Ego makes you reckless. Marty Schwartz from the book said, I always laugh when people tell me they made 10 out of 10 winning trades. That's not trading. That's luck or lying. Marty made millions by staying grounded. Even after back-to-back wins, he assumed the next trade could be a loss. That mindset protected him from overtrading and overconfidence. Paul Tudor Jones was a stop-loss disciplinarian. Jones built his legendary success on aggressive conviction, but always balanced by self-doubt. He once said, "Every day I assume every position I have is wrong." That's not weakness, that's strategic humility. It's why he was always ready to cut fast, flip direction, and survive. Michael Marcus said something powerful in Market Wizards. Being a good trader is a strange mixture of confidence and humility. The problem is, ego can kill you. He had to learn that the hard way. Early in his career, his confidence turned into arrogance, and he blew up. Only after embracing humility did he start winning consistently. The psychology of ego in trading. Here are 4 ego traps every trader must avoid, no matter how experienced you are. 1. The need to be right. Ego wants to be correct. But trading is not about being right, it's about being profitable. You can be wrong 60% of the time and still make money if your risk-reward is solid. 2. Over-leveraging after a win. Ego says, "I'm on fire. Let me double the next position." This is how accounts are blown. Confidence says, "That was a great trade. Let's stick to the plan and repeat the process." 3. Revenge trading after a loss. Ego can't handle losing, so it forces you back into the market to get it back. The result? An emotional mess, a bigger hole. Market wizards don't fight the market. They wait, they reset, they strike again with clarity. 4. Refusing to learn. Ego says, "I already know what works. I don't need to journal. This trade didn't work, but that's the market's fault." This is how growth stops. Market wizards keep learning, even after making millions. Building true confidence without ego. So how do you build confidence that's unshakable without drifting into arrogance? Here's the blueprint. 1. Build it from evidence. Real confidence doesn't come from believing in yourself. It comes from tested data, backtesting results, and trade journal analysis. When you've seen your system work over and over, you don't need ego, you have evidence. 2. Keep a humility ritual. Paul Tudor Jones constantly reminds himself, "I assume I'm wrong every day, so try this." Every morning, ask yourself, "What if I'm wrong today?" This keeps your mind sharp and your capital safe. 3. Separate identity from outcome. You are not your last trade. Win or lose, you're still a professional. Market wizards don't let a green day inflate their ego, and they don't let a red day destroy their confidence. They treat each day as just another step in the long game. Let's bring it back to Caesar. He conquered empires, but he always respected the weight of power. He stayed strategic. He didn't let early victories blind him to future risks. That's how the best traders operate. They walk into the market like Caesar into battle, prepared, humble, strategic, and deadly when necessary. Every great trader, like every great general, faces the same internal war: confidence versus ego. One leads to mastery, the other to downfall. The market wizards learned how to win that war over and over again. Losing as a skill. In 1974, in the steaming heat of Zaire, Muhammad Ali stepped into the ring with the most terrifying boxer alive, George Foreman. Foreman was younger, stronger, until this point, undefeated. Everyone said Ali was finished. But Ali had a strategy. He called it rope-a-dope. He leaned back into the ropes and let Foreman punch and punch and punch. Ali took the hits. He absorbed the pain. He waited until Foreman exhausted himself. And in the 8th round, Ali struck back and won by knockout. That fight wasn't won by dominance. It was won by knowing how to lose without breaking. Now, look at you. You took a loss, a big one. Your heart's pounding, your palms sweating. You're clicking through charts like they owe you answers. How could this happen? Why didn't I see it coming? I need to get it back. Stop. This is the exact moment that separates amateurs from the wizards. If you think becoming a great trader means you'll stop losing trades, you're dreaming, delusional, and dead wrong. The market wizards lose all the time. They just know how to lose. It's not about avoiding the punch. It's about learning how to take it and not fall apart. The loser's pyramid. Let's talk about how losing usually goes down for the 95%. Level 1. They lose money. They deny it. Level 2. They take it personally, like the market attacked their soul. Level 3. They go back in, heavier this time. Gotta win it back. Level 4. They blow the account. Blame the broker. Blame the Fed. Blame astrology. Sound familiar? Yeah, because everyone starts there. But market wizards escape the pyramid by learning one skill: how to lose like a professional. The wizards don't flinch. They expect to lose. They train for it. They bake it into the process. They lose early. Not at minus 20%, not at minus 10%. They're out at minus 1%, maybe minus 2% max. No hope, no prayer, just discipline. They journal the pain, not just what went wrong, but how they felt, what the urge was, what the setup looked like. They turn every red trade into a lesson, not a wound. Anyone can click buy. Anyone can click sell. But cutting a loser exactly when you're supposed to, with zero hesitation, with zero emotion, and moving on like it never happened. That's art. That's edge. That's how you stay in the game long enough to catch the big wins. This part might break your brain a little. Some of the market wizards have just 40% win rate, 35% win rate, and even 30%. And they're millionaires. Why? Because their losers are tiny and their winners are monsters. Small losses are the cost of admission. Big losses are self-inflicted disasters. The market didn't betray you. Your setup didn't betray you. Your stop loss just wasn't too tight. You just weren't trained to take the hit. So train for it. Expect it. Respect it. Get up from it. A trading loss is not a personal failure. It doesn't mean you're dumb, weak, or not cut out for this. It only means you're in the arena. You're learning, and you're getting closer. Only those too fragile to handle pain quit. Everyone else builds calluses. So forget revenge trades, forget emotionally doubling your position, and do these instead. Stop immediately. No new trades. Breathe. Step away. Journal fast. What triggered the trade? What was the plan? Did you follow it? Reread your rules right now. Remind yourself you're a pro, not a gambler, and visualize. Picture yourself cutting the next loser without hesitation. Again and again and again. This is how you become someone who wins by losing well. Ali won that fight long before the knockout. He won it when he made peace with pain. He won it when he stopped fighting the punches and let the storm pass. In trading, you will lose. The question is, can you take the hit and stay in the ring? If you can do that, you've already beaten 90% of the crowd. Pattern recognition. Seeing what others miss. A chess grandmaster doesn't just see 64 squares. He sees control of the center, weak pawns, fork threats, and traps 5 moves deep. Where you see pieces, he sees patterns. Where you see a game, he sees probability. Where you see now, he sees 10 steps ahead. This is what pattern recognition is all about. And in market wizards, it's one of the hidden superpowers of top traders. They don't chase the market. They don't react emotionally. They sit, observe, and see what others can't. When you look at a price chart, what do you see? Most people see noise, confusion, and randomness. But the market wizards? They see behavior, structure, and the market talking. Price is the ultimate truth, said Seykota. And to hear what price is saying, you need more than indicators. You need pattern fluency. New traders chase setups. Wizards recognize them. New traders memorize patterns. Wizards understand them. New traders force trades. Wizards wait for familiar signals to appear, like a familiar melody in a song. This ability isn't magic. It's screen time. It's deliberate observation. It's pattern recognition honed through years of focused attention. And you build this ability by showing up to the charts every day. You look at price action. You journal your trades. You review your screenshots. And over time, you start to notice things. That one pattern that tends to fake out before it breaks down. That setup that works better during London session. That moment when the breakout looks clean, but the volume doesn't confirm it. These are not textbook patterns. These are your patterns. Personal, tested, reliable. This is what market wizards build over time. A unique vision of the market that fits their psychology and style. Pattern recognition is built, not bought. You can't download it. You can't buy it in a course. No mentor can hand it to you. It's earned. One chart at a time, one mistake at a time, one journal entry at a time. It's quiet work. It's unsexy, uncelebrated. But eventually, you wake up one morning, open your charts, and realize you just know what the market wants to do. That's when you become a wizard. Pattern recognition is the quietest edge there is. Just intuition sharpened by observation. The market wizards don't trade with emotions. They trade with recognition. Their setups are familiar. Their moves are automatic because they've seen it before. Action steps to build your pattern mind. Screenshot every trade setup, before and after. Create your visual library. Journal the context. Don't just write bull flag. Write the story. Trend strength, session, news backdrop, volume behavior. Review weekly. Look back. What worked? What didn't? What pattern repeated? Track patterns across market phases. Does your favorite setup still work during consolidation? What about high volatility days? Teach yourself. Try explaining your setups to someone else. If you can't explain it, you don't truly understand it. A grandmaster might stare at a board for 10 minutes just to make one move. And that one move, it wins the game. The market wizards do the same. They sit, they watch, they wait, then they strike. At the right moment, with the right pattern, they win. Pattern recognition is not a hack. It's not a shortcut. It's slow burn mastery. It's the quiet development of a vision so clear that when your moment comes, you don't hesitate. You just act. And that action, that strike, is what separates a trader from a wizard. The trader behind the trades. Lifestyle, psychology, and self-mastery. You can have the best strategy in the world. You can have the cleanest charts, the fastest execution, the smartest edge, and still lose, over and over again. Because most times, the problem is not your system. The problem is you. Jack Schwager never said it directly. But throughout market wizards, there's a pattern most traders miss. The best traders have strong minds. But more than that, they live disciplined lives. Their habits, routines, energy, and mental clarity are all aligned with trading success. It's not just about what they do on the charts. It's about who they are when they're not trading. Market wizards live like professionals. They wake up early, they prepare, they review, and they reflect. They eat clean. They sleep well. They protect their mental bandwidth. Because they know you are not separate from your performance. You can't binge watch Netflix until 2 a.m. and expect to be sharp at market open. You can't eat garbage, ignore your body, overstimulate your brain, and think clearly during a spike in volatility. Your lifestyle shows up in your trading. The psychology of focus. Distraction is the enemy of execution. Every great trader in market wizards has mastered one thing above all: presence. They are locked in. When they trade, they are nowhere else. No background noise, no multitasking, no guessing. Just focus, precision, and control. That level of focus isn't built during trading hours. It's built in your daily life. What you do off the charts matters more than you think. If you can't keep your room clean, you won't keep your trading journal organized. If you can't stick to a sleep schedule, you won't respect your stop loss. If your mind is cluttered, your trades will be too. If you can't sit still for 15 minutes, how will you sit through a pullback? The market doesn't reward chaos, it rewards calm mastery. The 4 pillars of a trader's life. 1. Discipline. Wake up at the same time, follow a routine, and respect your rules. 2. Clarity. Meditate, journal, keep your inner world sharp. What's going on in your mind shows up out there. 3. Energy. Move your body. Eat real food. Sleep like your money depends on it, because it does. And 4. Simplicity. Eliminate clutter. Know that less is more. Focus on what moves the needle. Your life outside the chart is reflected inside it. This is the quiet truth, and almost no one talks about it. Everyone wants to talk about indicators, risk-to-reward ratios, win rates, and fancy monitors. But the trader who wins is the one who has mastered themselves. As Bruce Kovner said, "I'm not in this to feel like a genius. I'm in this to execute well." That's not trading bravado. It's life discipline. You are the system. Forget your indicators and your setups for a second. If your mindset is shaky, if your focus is broken, if your emotions are running the show, then you are the flaw in your system, which also means you are the edge. When you master your mind, your setup becomes more effective, your risk management becomes second nature, and your process becomes unstoppable. Because the greatest indicator is you. The market wizards didn't just learn to trade, they learned to live like professionals. So before you seek your next setup, ask yourself a harder question. Am I becoming the kind of person who deserves to win? If the answer is no, fix that first. Because the charts will always be there. But your mind? That's the one thing you either build or break. The final move. From trader to wizard, you've heard the stories, the legends, the rules, the risks, the mindset. You've walked through the minds of the greatest traders alive, not just what they trade, but how they think. Let's make one thing clear. You will not become a market wizard by watching this video. You will become one when you start doing what they do, every day, without fail, without shortcuts. What have you really learned by watching this video? You've learned that emotional control beats intelligence. That risk comes before reward. That mastery of one weapon trumps chasing many. That adaptation is survival. That ego kills and humility saves. That taking a loss is a skill, not a shame. That pattern recognition comes from obsession. And that your life outside the chart is reflected inside it. The market is not your enemy. It's your mirror. If you're scattered, impulsive, weak, your results will reflect it. If you are disciplined, focused, dangerous, the market will pay you for it. Not today, not always, but over time. So now what? You can close this video and move on. Or you can open your journal. You can start acting like a real trader. You can commit for the next 12 months to thinking, behaving, and training like the wizards do. Because this isn't about being lucky, it's about becoming the kind of person who no longer needs luck. There are a million ways to make money in the markets. The irony is, most people never find even one because they refuse to master themselves. That's it. You're not here to trade like the crowd. You're here to think like a wizard. And that begins now. If you found this breakdown of the market wizards valuable, then you will like the breakdown of Trading in the Zone by Mark Douglas. You can watch that video by clicking on the recommended video on your screen. And if you want more deep dive into trading psychology and how to develop the mindset of a professional trader, subscribe and join me in the next video.